Welcome back to Moving to Hampton Roads. My name is David Tortellini, and I'm once again joined by Jeremy Jordan with Atlantic Bay Mortgage. It's early 2023, so we're going to talk about interest rates in 2022 and the wild ride they took, and what we expect moving forward here in 2023. So stick around, and we'll get right to it. If this is your first time with the channel, make sure you subscribe so you can see all our future videos. And then do me a favor, leave a comment below. What other mortgage-related questions do you have that Jeremy can either answer for you, or we can make a video custom designed for you? Then when you're ready, give me a call, shoot me a text, or send me an email. We'd love to help you out. I'll have Jeremy's information in the description as well, so you can always reach out to him directly too. All right, let's get to it. Hey man, thanks for being here.
Yeah, man.
All right, so 2022, that was...
Wow.
Yeah. That was crazy. Interest rates, so...
No doubt.
Started the year off right around, what, about 3, give or take?
Historic lows, right?
Yeah.
Low 3s, and then we just saw this unprecedented, climb upward. And I think ultimately it spooked out a lot of buyers, from time to time. And I think we got so accustomed, just like with anything else, to having a rate in the higher 2s, low 3s that we saw for years. And then all of a sudden it goes to 4, 4.5. I'm not even sure I saw 5. It literally went overnight.
5. Yeah, we needed 5.
But then again, we started teetering around 7, and I think at some point, some of the prospective buyers kind of put the brakes and said, "Hey, I just want to let the dust settle a little bit."
Yeah, I agree. I mean, I remember I got in the business in 2010, and I remember interest rates at that point were starting to go down, and agents were falling out of their chair with excitement that interest rates went below 5.
Sure,
but if you've only know the mortgage market for the last 10 to 12 years, you only know rates between 2.25 and 4.5 at the most.
Agreed.
So
agreed.
It's been pretty sustained. It's not like it was a blip. It was a pretty long time that rates held pretty low, or very low.
Right, for sure.
And we're just not used to seeing these numbers.
I mean, one of the things that I like to do is, on social media channels, reach out and just make a generic post like, "Hey, go in and post what your start interest rate was when you first acquired your property."
yeah.
With the outlier being if you bought in, early 2020 and early 2022, you are not to put your start rate, but everybody else to put their start rate. And it's interesting because a lot of the time, folks were putting 8, 8.5, 10, 12, 13%. For their first. I know for me personally, when I bought my house in December of 2006, my first home, it was at 6.375.
Okay.
And I think the individual that actually helped me purchased my first property had been in the business 38 years, and I remember him telling me, "Hey, the rate that you're getting right here at 6.375 is unprecedented. Like, that is super low. You may never see rates that low ever again." But and that's somebody that had been in the business 30 plus years.
That's crazy.
So again, I think that we are in more of like a normal interest rate environment.
It's more normal. It's more just historically normal. It's just really hard to convey that to people on a regular basis.
For sure.
Because people don't care about normal. They care about the best possible scenario.
That's exactly right. And who knows? Like I said, I think going into this year, the belief across the board is that we are going to be in a situation, whether it be Q2, Q3, end of the year, I'm not quite sure, but the belief is that rates will hover back at around 5%.
Right.
Which, if they get back down to those levels, I think we're just going to see a mass influx of people, kind of come into the market. So.
Yeah, and I agree, because even this year, so, a lot of people towards the end of the summer when rates really skyrocketed, a lot of people dropped out. Like, most agents had very slow October, November.
Sure.
Then rates kind of came back down a little bit.
Right.
We're back down to like 6, something like that, especially for like our VA buyers.
Yep.
And December was a busy month. Like, I don't think the official stats are out yet, but that interest rate impact in, beginning of Q3 started bringing the average sale price in Hampton Roads down from like 335 down as low as 310 for November.
Wow.
But then back up to 325 in December. So all that loss was really kind of wiped out by just the interest rates coming back down to just a little bit better.
Right.
And people adjust, and it's the new normal. And
no doubt, man. And I think ultimately, a lot of buyers have come to the conclusion that they're not going to get so fixated on the long-term rate, because the one thing about a fixed rate mortgage is that while it is fixed for that duration of that period of time, the eligible, you have an option potentially down the road to refinance that to a lower interest rate.
You do, yeah.
And that's something that we, when I'm having discussions with first time buyers or just buyers in general, I'm not saying I can guarantee that you're going to get a lower rate here in 6, 9, 12 months or 2 years from now.
Sure.
But so for those types of buyers that are buying right now, we're selling more to making sure that payment is in their comfort zone.
Yeah.
Because we know if their start payment's in kind of their comfort zone, then we foresee that the ability to get that payment down much lower as rates continue to go down. Hopefully, at some point this year. At
some point, yeah. I think the idea that they're going to drop significantly anytime soon in the immediate future is probably a little optimistic.
Yeah, a little optimistic, yeah. And there's a graph that we'll go through down over the course of this broadcast today that I'll kind of give you some insight as to why I think rates will be kind of going back down at some point in 2023.
Yeah, that'd be great. I mean, I think we had talked previously about how it's unfortunate that rates had to shoot up so fast based on, I think the junior economist in me believes that the Fed waited too long to raise base interest rates, and that could have been done more gradually and not have it be such a dramatic slam on the brakes type of environment, if we had maybe made those interest rate increases a year earlier and just kind of started doing them because the writing was on the wall.
That's right.
For a long time.
Yeah.
Like we'd sit around going, all right, when are we going to start raising these things up a little bit? Prices are going up, 10%, 12%, 15% year over year.
Right.
This is not sustainable.
Right.
And
I know all the news and media outlets were, kind of pushing that inflation was more transitory.
Yeah.
And I think we found out that it wasn't.
Right.
It wasn't transitory. That,
yeah.
That it was here to stay.
Right.
And again, that's kind of put us in the environment that we've seen here most recently within the last couple months.
Yeah, I think the inflation numbers have been fairly positive the last recently. So I mean, positive in the sense that they were slightly lower than expected, but they were still in the sevens, I think. So it's not, can't keep that up forever. But,
right.
But we're not, was it like Argentina where they're like 800% or some crazy number like that.
That's right.
So we're better than them. So
well, this is a kind of good segue if you want. Like I'll go ahead and show you this chart that I've wanted to show our audience today. And this material is brought forth from what I feel is the best or the top ranked mortgage site in the country, which is a company led by Barry Habib, which is called MBS Highway, and they just do such an exceptional job of this is a monthly subscription that I pay for to kind of be on their network. But I think that this slide just kind of best gives the folks at home kind of a snapshot and gives them I know I'm more of a visual type learner as well.
Sure. Yeah.
So visually this kind of gives them a an overview of mortgage rates and kind of where they are and where I think they're going, kind of moving forward. So
sure.
If you kind of take a look at this chart, kind of envision the type line, the white line or the blue line, kind of being the 30-year fixed rate. And then the kind of that pink line right there is the CPI or that, consumer price index, otherwise known as kind of inflation. So one of the things you'll see is that, that mortgage rates, tend to lead from inflation. So as inflation, rises, usually mortgage rates rise. And as inflation softens, mortgage rates soften as well. And you'll see a couple periods here where inflation's gone flat and the mortgage rates, tend to go flat. So this slide I think gives you an overview. That white area right there is that QE period or that quantitative easing period where the feds were basically going in and purchasing, mortgage-backed securities. And they were, kind of artificially keeping those rates, at or around, kind of 3%. So, you can start to see that kind of that pink line, that CPI, through those areas of that quote unquote, that transitory, belief of inflation. And you'll start to see that there was basically no choice. That as that CPI index or as inflation rised, 30-year fixed rate mortgages had to rise.
Absolutely.
And if anything, one would argue that the rates could have been significantly higher than the levels that they were even at. But these CPI indexes or inflationary readings are based on a kind of like a rolling 12-month cycle.
Okay.
So the reason kind of going into 2023 that we feel like there's an opportunity for some rate improvement is that some of the higher indexes that are utilized from that CPI index. Let me kind of transition here. Just some added material that I have here, but as you can see, some of the the indexes for again October, November, December of last year were 0.6, 0.5, 0.6. January is 0.6, February is 0.5. Then we do have a little bit of a dip in March, but then we see 0.6 in April, May. 0.7 even in June, and that's why the belief is that come once we kind of get rid of that rolling 12-month period and some of these larger, inflationary, indexes start to kind of roll off a little bit, we do feel like those rates are going to kind of come back down as indicative of kind of what we've seen, in October and November, at 0.3 and 0.2. So, the writing is on the wall, that rates are headed back downward at some point. And again, that's why the belief is, that rates will be, maybe in that 5% range, into second quarter, third quarter, fourth quarter of next year.
So it really is all based on, inflation has such a huge impact on mortgage interest rates.
It's like the number one criteria, right? The one thing that it's been a little bit misleading from a consumer standpoint is the fact that, these Fed rate increases have almost kind of directly led to mortgage rates increasing. So the belief from a consumer standpoint is that, the Feds are raising rates, our long-term rates are increasing as well. It's not the case.
Right.
It has felt like that.
It has.
But just from a timing mechanism. But that's it's a different indicator.
Okay, so that's really good to know because I don't think most people know that. No. I think people just think that the Fed rate and the mortgage interest rate are directly tied to one another.
Yeah, the Fed funds rate is not directly tied to mortgage rates.
Okay, so that if that's the only thing people pull out of this video, I think that
a little something.
We all learned a little something. So that's really good to know. So with people, this year having to, close loans at, 7.25 and at some pretty high interest rates. I know we've done some like adjustable rate mortgages that have helped keep, prices down a little bit, things like that. But there's always the opportunity if they do come down to refinance. So I figured we could talk about a couple of different scenarios. So obviously Hampton Roads, huge military area, tons of VA buyers. Now, the VA loan, my understanding is pretty easy to refinance. Is that right?
For sure, yeah. And really the only criteria there is that you have to have purchased the home, and there's a waiting period now on those interest rate reduction loans, and it's 210 days.
Okay.
So 210 days from the time the closing takes place before you're eligible to refinance that.
Okay.
That's an important number because, again, you don't want to set this false, sense that somebody, gets in at 6.25 and then rates drop to 5, 4 months in, and they can go refinance it.
But it's only 7 months, right?
Yeah,
it's not that long,
No, it's certainly realistic, and those interest rate reduction loans are, no appraisal requirements as well.
Oh wow!
As long as the loan is current, we can restructure that, and you have to have a minimum of 0.5% reduction in the rate, in the interest rate.
Okay.
I'm of the opinion that it is a case by case basis. I think 1% drop is typically where, most folks tend to want to be.
Okay.
So if I'm at 6, dropping it to 5 usually kind of is when it starts to make the most sense.
And now, is that regardless of loan type?
Yeah, I think regardless of loan type too. I mean, that's always kind of the way that I've, kind of run my business.
Okay.
Now, there are instances where, it makes sense at 0.75%.
Okay.
And then we run the numbers, and I'll tell the client, hey, instead of that normal break-even point to recapture the closing cost portion of being 18 months or whatever, it might be 26 months.
Got it.
And as long as you plan on being in the home for 26 months, then it makes sense.
Okay.
But we'll lay out those options to the consumer and just kind of give them a couple different options.
Okay.
If we're servicing the loan as well, that makes That's helpful as well because we can just transfer like the escrows for their taxes and insurance and not have to recollect them as well.
Gotcha. So that saves on those closing costs.
It saves on some of those transferring of closing costs over that. They might get a refund from their current servicer, but you might have to add, another couple $1,000 back to the loan, which increases their monthly payment. So,
right.
We really take time to kind of lay all those out and break all those down for them.
Yeah. So it really is a case by case basis.
Case by case basis. You can't go wrong with 1%, in my opinion.
Okay.
But again, from the VA side of things, minimum of 0.5%.
Okay. And
then that 10-day waiting period is also important.
Okay. And that in 210, that's strictly for VA.
Strictly for VA.
What about conventional?
It's different. I mean, 6 months. In the industry, I think it normally is. You need to wait 6 months.
What's the difference?
But if it's a conventional or FHA loan, but again, that 210 days is important on the VA side.
Okay, that's great. I mean, that's great to know. Just because I think there are so many people that are in a payment right now that they're not thrilled with, but they're dealing with it.
I wanted to get a shirt made because the sayings, everybody was saying it. Buy the home, date the rate. That was like
the slogan of
2022, right? And I just wanted to get shirts made and wear them every day.
Yeah.
But again, I think for buyers right now, like I would absolutely tell folks now is the time to buy.
Yeah.
And again, I think as we potentially see in a rate environment where they're going to go back down, I think we're going to see some of what we saw in some of those 2021 markets from a competition standpoint where folks were having to bid way over ask and pay exorbitant amounts over and above the sales price.
Yeah.
Because we may be headed towards that environment because builder confidence is down. There's not as many homes currently being built.
No, it's crazy.
And again, there's not quite as much inventory. When these rates come down in inventory, potentially, we'll see what happens with inventory, but when demand for housing increases like it was then, and then rates have kind of come back down, we're liable to see a situation that was very similar to what we saw.
We could, because so many things are relative to just how people are feeling about the rates, not necessarily the math on it. It's like when rates are 7, and then 6 months later they're 5. 5 seems incredible.
Oh, for sure.
When it's the opposite, and rates are 3, and then they turn to 5. 5 is the worst interest rate in the world. But so just I think people will see it as an opportunity to jump back in the market, maybe make the upgrade that they had been previously holding off on, or and it's been tough for a lot of people who are holding on to like I have a 3 1/4 on my house. It's really hard to give up that rate,
doubt.
But at the same time, at a certain point, probably have to move at a certain point, it's like, so, if interest rates can be a little bit more palatable, I think a lot of people will jump back in and hopefully, and we'll start to see that increased competition again. But I would hope that it just doesn't get to what it was because that was crazy.
I know, man. And it's tough on buyers. Everybody gets so stressed out.
Yeah.
But again, that's
left and right.
Again, another one of the reasons why if I had my choice, to kind of buy now, with the notion that rates may come back down and I'll be able to refinance that, I'd much rather be competing against 1 or 2 contracts than 8, 10, 12,
for sure,
and have to go, and again, the nice thing about refinancing down the road is that you are eligible to just kind of roll in those quote unquote closing costs back into the loan. So it's no additional, funding out of pocket.
That's awesome.
That's awesome. Save on the rate, get your payment lower.
Jeez, wish we could do that on the initial purchase.
I know.
So many buyers would be so happy, especially our young VA buyers and everybody who haven't had that opportunity to save up the $6,000-$10,000 it takes to close on a loan.
For sure.
So that's great, man. Well, I think we got a lot of really good information today. Interest rates, hopefully will be coming back down a little bit here in 2023, make things a little bit easier on folks, get back in the market, and we'll just be here to help them out when they're ready to go.
Yeah, and I think the other great thing right now is we're seeing some contracts coming in with, on occasion, sellers covering some buyers' closing costs as well.
Yeah.
So, what a great opportunity for buyers that really haven't had, the opportunity to get closing costs paid for by sellers.
Now's the time. Because if rates do go down a point, That's probably going away.
That's probably going away.
Yeah.
So again, I think it's just a fantastic opportunity. Obviously, we wish rates were a little bit lower at the beginning, but just the ability to get that rate down lower down the road and get into a home of your dreams right now,
awesome.
Makes good sense to me.
Yep, that sounds good, man. All right, well, I really appreciate being here. Lots of amazing information. Hopefully, people take away some good stuff from today's conversation. All right, thanks, Jeremy. Appreciate it.
Bye.
Thanks again to Jeremy Jordan with Atlantic Bay Mortgage for joining us. Again, his information will be in the description below, as well as a direct link to apply for a mortgage if you are ready to start that pre-approval process. In the meantime, like this video, share it with anyone else you know who may be looking to buy a home in Hampton Roads in 2023. And then, of course, subscribe to this channel. When you're ready, give me a call, shoot me a text, or send me an email. Jeremy and I would love to help you out with your next home purchase. Again, my name is David Tortellini. Thanks so much for watching.